Owner finance, it's a valuable tool in real estate and what you need to know as a buyer or a seller if you're planning on doing an owner finance and some of the pitfalls to avoid. To hear that and more, stay tuned to this episode of The Den.
The Den, powered by the Lyons Group, a show dedicated to exploring hot topics in real estate, local happenings, and industry trends. We're a small team of professionals approaching $400 million in sales and nearly 2,000 local transactions. You're listening to time-tested experts and industry leaders. Here's a refreshing look at real estate happenings and more. Welcome to The Den.
Hello, everyone. Welcome to this episode of The Den. Today, we're going to be talking about owner finance. Is it something that you should use or have in your bag of tools in real estate? But before we get to that, let me introduce my friends, my partners, my co-hosts, the fellow members of the Lyons Group. To my left, Paul, Hammy the Rockberry, Aspen the Ninja Gruen, Shannon the Boss, Martin Martinez, and my name is Ben Lyons, and I'm your host of The Den, Top Brokers Taking on Tough Questions. So today, owner finance, let's talk a little bit about buyer side, seller side. But first of all, before we get into that, what is an owner finance? Maybe we can talk a little bit about Shannon. I'm just going to throw it at you. I love just putting people on the spot.
Well, I would say
kick it out. Tell us, tell us what owner finance
is. When you got two parties, a seller and a buyer, and you don't use cash or a lender, and basically the seller becomes the bank, the financer. You know, your buyer is basically going to pay you as if they would a lender. They're going to pay you the principal interest and your interest, whatever they're going to charge you for it. So those terms can look different from deal to deal, but I would say in short, if you're looking at what owner financing is basically when your seller is your bank.
When the seller is the bank. Yes. And so that's really kind of a simplified version for our viewers, that the seller is acting like a bank, but you may have an underlying mortgage on that property. So I'm going to go over to Aspen because you've done quite a few of these over the years. And I would consider you an expert in real estate owner finance. So let's talk a little bit more about the process of an owner finance. How does that work? Do we treat it like a normal closing? What happened? What's the process? Give us kind of a rundown there.
So if you're considering doing an owner financing, and again, that can be called different things in different areas. So Colorado, we say owner financing or seller carry. Here in Mexico, we call it a real estate contract, which can be kind of confusing for some people. But basically, one thing I always want to know beforehand is, do you still have a mortgage on that property? And if you do, are you going to have a due on sale clause? Because that means that once you transfer the property into someone else's name, then you are going to have to pay that mortgage off. And some banks will, even if there is a due on sale clause, I know some local banks will work with you on that. And it's called a wrap then, where you're wrapping the mortgage into it. But that's a little bit risky for the seller because now they're second in line if the buyer stops paying. So I always want to know if there's a mortgage right off the bat, and is it going to be paid off? Or are you going to be wrapping that into the final cost?
So good points. And those are next level points. But for our viewers who may have not done an owner finance before, can you talk to us about, here's kind of the basic process. A buyer's interested in your property. They come to you, and let's assume there's no underlying mortgage. Okay. So the seller owns it outright. Walk us through that process.
So the first thing that we would discuss is, what are you wanting to pay for it? So your down payment. Typically, it's a little bit higher on owner financing than it would be on a loan. So let's say you're paying 20%. And then what are you wanting to pay monthly? Because that will make a difference on if you should put more down, less down, and what the interest rate should be. So we can adjust that. And then we normally will look at what the interest rates are right now. And so let's say, 6.5%, you might be paying 7%. So owner financing can be really beneficial if you maybe don't have the best credit or you have a high debt to income ratio. So you're looking, to buy an investment property, but you don't know if you could get approved for a loan. So we would want to know. And then also when you are going to be paying it off. So when is your balloon period? If you're going to be paying it off in 5 or 10 years, and if it's based on a 30-year amortization rate, you're going to have a big payment due at that 5-year mark. So you want to make sure you can get your financing in line in 5 years.
Yeah, so great answer there. And thank you for walking through that, because I feel like a lot of our viewers probably don't understand the full concept of how an owner finance works. And we do treat it as a normal closing to a large degree. There's actually title insurance. There's deeds that are signed. They are held in escrow. Let's just walk through an example, Paul, you and I. If I'm a buyer and I come to you and you're asking $100,000 for your property, and like Aspen mentioned, I go, look, I want to buy it for $100,000. I want to put $20,000 down. Then you and I negotiate the interest rate and the term, like you alluded to. So in other words, you can pay me, let's say 7% interest on a 30-year amortization, and that makes our payment this. But within 3 years, you need to balloon me out. So that was a term that Aspen just used, but that means just a balance paid in full to seller. Now, you can have other types of balloons where a $5,000 balloon is due in 2 years or some things like that, but not to complicate things. Let's just keep it straight as a balloon payment, balance paid in full as a seller. Now, what about the interest rates? The thing about owner finance is you can negotiate any interest rate. With a bank, you're beholden to market rates for the most part. Owner finance, there's some more flexibility. Speak to the flexibility of interest rates and then also down payments, some of the levers that buyers and sellers have.
Well, going back to what Aspen was saying is if you have less than stellar credit, you don't have a larger down payment, because I use a real estate contract sometimes, like for investors. If you get financing, you have to put 20, 25% down. A lot of times I'll say, we'll just cover cost and then we'll do maybe a higher interest rate so the owner gets a higher monthly payment. But on the interest rate, a lot of times you just need to make sure that if there is an underlying note, that's paid. So your interest rate, you really try to figure out where that monthly payment lands. You like to be at least $100, $150 over what they owe if there is an underlying note, or just have a monthly payment that if there isn't an underlying mortgage that the seller is okay with. So you have a lot more, like on commercial stuff, it's usually prime plus 1. If you go in a real estate contract, you can go 2, 3, 4, 5 points under that.
Yeah.
So it's whatever the buyer and seller. My first year doing it, I think I did one real loan. I did mostly cash and real estate contracts. So this was normal for me at the beginning, but it's really when you keep the lender out of it, you keep the appraisers out of it, you keep everybody out of it. You just say, buyer and seller, let's work a deal.
Yeah.
It's kind of like old school real estate.
Yeah, and to some degree, and we build in those protections. So when a buyer makes a payment to an escrow company, because we install an independent third party that collects these payments, and then they pay the underlying mortgage, and whatever is left over is what Paul was saying, $150, $200, sometimes a lot more. They'll pay that to the seller. They want to make sure that buyer wants assurance that his payment or her payment coming in is going to that underlying mortgage first, and then the remaining amount going to the seller. That protects all parties involved. We've been pretty good about protecting people over the years, but there are some caveats to that. And to your point, the due on sell clause. Now, a few years ago, I spoke with Rick Tom, and Rick Tom had one of the biggest escrow companies here in New Mexico. And he said, Ben, I don't hide the fact that I'm sending Wells Fargo 200 checks every month. And mostly they don't care. As long as they're getting their payment, they understand that someone sold it on a real estate contract wrap with a due on sell clause. Typically, and I should say typically with an asterisk, the bank does not exercise their due on sell clause unless they don't receive their payment. So if this buyer that you sold on a real estate contract misses their payment, that doesn't let you off the hook. You still have to make sure that payment is made, because if you don't, that's going to raise a red flag with your underlying mortgage, the lender you've been working with all those years, and they can exercise the due on sell clause. So what are some of the other pitfalls that you could think about if you're a buyer? Shannon, what are some of the things you should think about as a buyer or a seller, I should say, with owner finance? What are some of the things you need to avoid?
Well, I think that having a good realtor, we can make sure those things are lined up. But I agree with Paul. You always want to make sure that if you are wrapping a loan, that your loan is going to be paid off, if not before, at the same rate that you're paying. That way you don't end up, I paid my amount, but the seller still owes a mortgage on this property. So that's a huge pitfall that could happen if you're not doing it right. I think people need to know that when you enter into these, basically you do have that third party that's going to make sure everything gets done. And that adds a lot of protection. You will have each individual, the buyer and seller, deeding the property to each other. And those are going to be held in escrow until something happens. Either it's paid in full and it's going to go to the buyer, or it is foreclosed on and it goes back to the seller. So we have those protections built in. We have a lot of ways to make sure. It's just like with a mortgage, though. Things can go wrong. People can quit paying. And it's not to say that it's going to be easy, but your protections are in place when you do everything properly, that you don't have to worry too much about all those problems if you have someone up front doing their due diligence, doing the work, making sure they're laying the foundation for that.
Yeah, I think that's really important. I mean, it's a great point. You have to get with a realtor to navigate these waters, because we've seen situations. In fact, I came in secondhand where an owner sold to a gentleman on an owner finance, and he didn't do title insurance. So he didn't go through the proper channels. They just agreed and he started making payments. Well, who recorded the payments? Who's that independent third party? Does the owner have legal title still and the buyer have equitable title? I mean, those things start coming into play. So there's really a lot of pitfalls. It's not done right.
And insurance, that's another great point. Hazard insurance, you consider that. So say the owner still has their hazard insurance, but if the buyer doesn't go out and get hazard insurance and that property burns down, the seller is covered. But are you? Yeah. Even though you may have been paying on that property for 10 years and you're almost paid off, it caught on fire now and he's still getting his balance for the house, but you may not be getting it. So there's a lot of things to consider in that. And some people really get upset about that and they say, well, why are we paying to insure? This is wasting money. Why are we paying to insurance? Why are we doing, there are ways to get around that. You can add the additional insured to your policy if you want to. You can get separate policies. There's a lot of things you can do, but you have to know. And a lot of times when people are doing it on their own, they don't know those things to watch out for.
Yeah, it can be scary for sure. Thoughts, or you want to add on to that? What Shannon was saying?
Nope.
That's all right.
They didn't think much about
what
I had to say.
We agree.
We agree.
Great point. It's a great point.
No, I think one of the big things has been the insurance over the years, because there's a lot of confusion there. Like, who's covered? Because if you're paying on this property and you're the buyer and the house does burn down and the insurance company shows up, they're going to be like, who are you? Like, I'm working for the underlying notes, mortgage, and this other person, the seller that sold it to you, and I'm not dealing with you. And that means that buyer could be cut, if it's not set up right, could be cut out of any protection there. And that can be a scary thing. And then also, what about going in and knocking walls out? I'm going to open up this kitchen when they do they hire cousin Eddie to come over and help them, knock walls down and try to put some stuff together that they think is good, but it's not done with a professional contractor. You have to build in some protections in that regard. And that's where getting with a competent realtor is really important. I think one of the biggest things is the flexibility, right? You have the ability to move these levers. And we've done a lot of transactions over the years that involved owner finance. And I can remember 2 deals over the years didn't work out. One was where she didn't do the title insurance I was just alluding to. But the other one was where a gentleman, he had lost his job and got transferred out of the area. And he just put, I think, a small amount. I think he put 10% down. He gave me a call and said, Ben, who do I turn these keys back into? Because it's a different process to get the property back. In New Mexico, it's not a full foreclosure process. Maybe you can speak to this in Colorado, but is that a full foreclosure process, or is it more of a...
It's not common at all in Colorado to do owner financing. It's very, very rare. In fact, I've only done 2 commercial ones on owner financing in Colorado. No other ones.
And in New Mexico, I just dealt with this, I think it was this year, maybe last year. It's more of kind of like they do mediation. The escrow company will give notice after 60 days of non-payment. They'll give notice, and then the seller has to go to the buyer, say, can we square this up, or do we need to renegotiate terms? Then after that 30-day period, then they can start the eviction process.
Yeah.
And it reverts back to the owner.
Yeah. So you have a demand letter basically sent. And then saying, hey, you are in arrears. You haven't made this payment. You've got a period of time.
I think it's 30 days.
30 days
in our contracts
to bring it current. And from there, so as a buyer, you have to be really careful, because you put 20% down and you become 30 days in arrear on a payment. They send you a demand letter and you don't bring it current in the next 30 days. You risk losing all of your down payment, all of the payments made up to that point, and becoming more of a tenant that gets evicted versus a partial owner.
I just had that happen on a listing of mine. They called me to the tenants. They ended up being tenants because they had a real estate contract, but it was not how I would have done it. There was a lot of things changed and filled in on the sides, and reading through it, it ended up just being almost just a lease agreement. And then they had until a certain day to buy it, and they couldn't get approved for financing that time. And so it just went back to the sellers, and it has been a long and messy court process. And the house was not kept up according to the contract that they had. They've lost quite a bit of money on what they could have sold it for. It's a really unfortunate situation for both the buyer or the tenant and the seller, because there wasn't anything in place to really help them. So I came in at the end and kind of being like, it's too late to do anything. We're years past when we could have done something.
Yeah. And that's a good, an analogy would be like, here's a soccer ball and there's a field, go out and play. Mm-hmm. And no one's out there going, hey, here's the goal line, or here's the out of bounds. And then you just leave it up to them to play square. That's hard. But I think you brought up a great point. I want to talk about that a little bit, is what's the difference between an owner finance and a lease purchase? There's a big difference. If anyone wants to jump in and speak to that, I think it would be good for people to understand.
Well, just come back to me on the last topic because I have something to add to that.
No, go ahead. Why don't you do that before we talk about lease purchase?
I had something on a commercial deal. A guy owned on a real estate contract numerous office spaces. So we started to list them all, and we talked to the lender that held the note, and he says, yeah, you can sell that one on a real estate contract. But then what happened was we sold that one on a real estate contract. We tried to sell the other one. They go, okay, we can't be second on these notes. Mm-hmm. They said to sell that one off, you have to pretty much pay off the entirety of the note. So luckily he had the cash to do it. But when we start dealing with investment properties, bundling them all into one loan or trying to sell them on real estate contracts when you have an underlying note, that can get very tricky very quickly.
Yeah.
So if you're out there trying to do that, make sure and talk to a pro.
And you have some banks, like a local bank, will typically work with you. They'll look at it and go, okay.
This was a local bank that said, well, I need $90,000 for you to do this.
Sure. And to that point, the local bank will go, we can do one, but you can't on the other one. You need to do that. So that's what happened there. Some of the bigger banks, they don't care. If you're selling any aspect of it, it's going to trigger that due on sale.
But that was my one experience with the due on sale.
Yeah.
To do that one, we need to be paid off.
You need to be paid off. And rightfully so. It starts getting too convoluted, and the bank has to protect their interest. So Shannon, talk a little bit about the difference between a lease purchase and an owner finance, and why typically, and I'm going to throw this out there, why typically lease purchases don't work as well as owner finances anyways.
Well, I think when you're in a lease purchase situation, you really don't have any ownership. When you record a real estate contract, there's some teeth to it. You actually have your name on the deed. You actually have a third party recording your payments coming in and putting them towards the balance that you owe. If you just have an agreement, like I'm going to rent this for 10 years and then I'll buy it and I'll get back some of the rent or whatever that agreement may be, I just don't think that you have the protection in place. You also have a lot of questions. You're still just a renter. So what happens if you don't have those things in place? What happens if the water heater breaks? You're buying it. So do you do it, or you're really just a renter now? Does the seller do it? I think there's just a lot of gray lines there. I think for some people it may work, and it's a way to get your foot in the door, and it's a way to get yourself maybe to a real estate contract or to a loan with getting a little bit of equity out of your rent that you've been paying. It can work for someone, but I don't think that you don't have the protections in place where I think if you're really planning on buying it, go with the owner financing. I think you just a better shot at, protecting your investment in the house as a buyer.
Yeah. When I hear owners say, I'll just lease it for a few years, and I go, whoa, wait a minute. They may say the market will be better in a couple of years or whatever. I stop them and say, do you really want to lease to someone who's not going to take care of this asset? They may, do damage on it for the next few years, and you're hoping and banking on the market being better when you can offer out an owner finance and someone puts down a significant amount of money. They're vested in that property. They don't want to take care of it. They're not going to let the grass go. There's parameters to their ownership. There's parameters to when you're going to get paid off. Because in this situation, you're talking about the lease purchase. What happens in the market goes crazy in 5 years, and the buyer goes, "Oh, I want to buy now," and the seller says, "I don't want to sell it now. It's worth double what we had talked about." And so, if you don't have those protections, it gets a little squirrely. I have yet to see a lease purchase work out in all these years. And that's why I caution our people watching this. If you are looking at a lease purchase, really think through that. Or is an owner finance better, where it protects all parties involved?
If I'm a buyer, I want my name on the deed.
Exactly.
Because it's like a memorandum of whatever, but I want my name somewhere on there that the sellers can't sell without me, approving it. So I would never, I don't think, do a lease to own. It seems risky to me. Which is probably why we don't see.
Yeah, we don't see them very well. Yeah, we may come in after the fact and trying to clean up the mess, which is hard to do sometimes. So we've seen some interesting situations over there. One more popped into my head. It was the same situation where they didn't do a title insurance on it, and the buyer had federal liens, tax liens against him. And so what happened was she did an owner finance, but since he was attached now, the liens attached to the property, and he stopped paying. And so she's like, okay, well, I'll just get rid of him. And that was fine. He was ready to move on. But guess what stayed?
Still has his debt.
the tax lien stayed on the property. So there's some things to look out for
That's why our real estate contracts are so good too, our own seller financing contracts, because it says if there's any liens on the property, who's paying them? Are they going to be wrapped into the payment? It goes through every little item.
Mm-hmm.
And we actually don't have something like that as good as the New Mexico ones in Colorado, which might be why we don't see it quite as much.
Mm-hmm.
That was surprising you said that. New Mexico was better than usually Colorado is. Yeah.
Yeah.
But we're getting good at real estate contracts because lending is kind of tough right now.
Yeah. What situations would you see someone doing in owner finance as a buyer? I mean, one thing that jumps into my head is someone who maybe just started a business and they don't have 2 years of returns, but they have some liquid cash and they've shown a good track record. Would that be an instance where someone would want to do an owner finance? What's another situation?
Maybe a retiree. This is going to be their retirement income. You can probably get a lot more money out of it if you stretch it out over 10 or 20 years for somebody and you're collecting, 6, 7, 8% interest every single month on top of that regular payment that you would be getting. So you might get your $100,000, but you might get another $40,000, $70,000 depending on how long you let it go. And if that's your long-term income, why not get a monthly payment instead of all at once?
Yeah, there's
more money.
There's a reason why these banks have big buildings and a lot of employees. They make interest. And so as owners, if you can make interest on your investment, that's huge, especially if it's front loaded. What are your thoughts about some other instances where it would make sense for a buyer to purchase on owner finance?
I use it as alternative to financing a lot. Like if they can't come up with a down payment, or if a seller's willing to work with somebody that has a foreclosure or a bankruptcy or something like that, they make good money, but they don't necessarily qualify for traditional lending. The down payment has been a big one. And with interest rates, when they got up to high sevens, it was maybe I could work a deal to get you in the fives and you can afford that, but you can't afford the higher payment. That's when I've used it a bunch. And investors. Every investment property I go for, that's the first question.
Yeah.
Will they do a real estate contract?
Will they carry a contract?
Yeah.
What you nailed something there. We've had good people that have had bankruptcies over the years. They've had health challenges and couldn't pay their medical bills. And they've been good. They're 40 years of their life and then have had this challenge and they've had to file bankruptcy. They can't get a loan. They rightfully should be able to get a loan if all the terms are met and a seller is agreeable to it. So that would be an instance where an owner finance would work. And to your point, then it works for the seller because they're making interest on their investment. So a great conversation. We're going to end it here because we're running out of time. Let's jump into the speed round. What is I would say, the biggest, and I left it blank.
I like that question. The biggest.
What is the biggest? What is the biggest issue or problem or pitfall that you see with owner finance, Paul?
Getting a good escrow company to keep track of everything is vital because when it goes wrong quick. And then the other thing is when you agree with somebody, know that they now own the house. They can do whatever they want with that house. We have a couple of clauses that says you can't sell it without consulting the original owner first. But I think what I hear from a lot of people is, but I still own the home, right? Or I always tell people, you can't go and check on the house. It's not yours anymore. Yeah. It's theirs. So I think just making sure you have a good escrow company and then making sure you understand, both sides understand all the terms.
A clear understanding of terms. Absolutely. Aspen, what's the biggest pitfall and maybe the biggest pro?
I think one of the biggest issues that I could see happening is if you are an investor and you're getting all these real estate contracts and they're all due in 3, 5, 7 years, and you actually don't know if you can get a loan for those. I think you need to talk with your lender prior to doing a real estate contract. You need to know that in 3 years, you can get a loan because if you can't, all that money is just lost down the drain.
Yeah.
And for me and the people I work with, which is primarily investors, the biggest pro is it doesn't show up on your DTI. That's the biggest pro for a real estate contract.
Yeah. And you don't have to bring out all your stuff and your DNA to go get a loan.
Yep.
So that's fantastic. And great point about the consulting a mortgage broker. A lot of people don't think about that. Well, I got to refinance in 3 years. I better make sure I can. Yeah. Otherwise you lose everything. Shannon.
I think what I would want to mention more than anything, not just a pitfall, but just know that it's not for everybody. For some people, this works amazing and they can have numerous real estate contracts, whether you're a buyer or a seller, and it could just be flawless and work really good for you. But it's not for everybody. Not every seller is going to have the stomach to wait out so many years to get their money or to wonder if, it's going to get paid off or to pay the payment themselves if somebody isn't making it. It's not for everybody. It's not a right fit for everybody, but it is a very, very valuable tool. When it's needed, it's something to consider and fall back on.
Well said. And I think I would round that out with saying the same thing. I think that it's a wonderful tool if it's the right fit for you, but you need to get someone that understands owner finance and help them navigate the channels with you. Whether you're a buyer or seller, there are safeguards in there to protect you and help both parties, because ultimately we want to make sure everyone's protected and they understand the rules of the game. And that's important to make a win-win in real estate. But what an incredible tool, especially for investors or people that may not be able to get conventional financing. Owner finance is really a tool that should be used when it's the right fit. So thank you for that. On to my favorite part of the podcast, which is called the Lyons Pride. And as Lyons Group members, we give back to our community in special and unique ways. We like to honor others that do the same, whether it's a person, an event, or an organization. We like to recognize them and tell them thank you for helping our community become better. Shannon, the boss, you're up today. Who would you like to highlight for the Lyons Pride?
So I want to talk about the summer lunch program and what that brings to our community. And I think that sometimes we take for granted that it's summertime, kids are home, everybody's just home, but there are a lot of families in our community that depend on the school system to feed a nutritious breakfast and lunch to their kids. There is a lot of kids who maybe don't have that stability at home, and they rely on that time with adults and with just kind of being, nurtured and cared for. The school system, and they do this in Bloomfield, they do it in Aztec, they do it in Farmington. I think it's put on by the Farmington Municipal School System and the city of Farmington. And I know that some of the cities like Bloomfield and stuff participate in as well. They also get some grants from the Department of Agriculture, I believe, for funding for this. But during the summer months, from as soon as school gets out to the time they go back, there are numerous locations throughout San Juan County. They are everywhere here. They're at all the schools. They're at most of the parks. They serve hot breakfast at one or two locations around town. They serve lunch at numerous. And then there are a few locations where they serve like a late snack, late lunch, like around 3 to 5. That is vital for some of our families in San Juan County that don't have those resources, or, parents just aren't home to make sure that their kids are provided for well, but they do have a park or a school right next to their house. Kids can go there on their own. There is no need to sign up for it. There is no registering for it. If you are under the age of 18, you can show up and you can get meals served to you basically 3 times a day. And that is put on by our community. There's a lot of people that make that happen. There's a lot of state dollars, local tax dollars that make that happen. And I think that it's a fantastic program just to keep our kids in the vein, make sure that they don't drop off and get lost. Their nutritional value doesn't go down during those summer months.
And it's a summer lunch program, what it's going, even though they serve breakfast and lunch and snacks. What a great program. Yeah. I mean, we forget about a lot of the kids that are underserved in this area. And I shouldn't say we forget about them. They're not on the radar oftentimes, especially in the summertime, because there's no school in.
Right.
And so those kids still have to eat.
And a lot of these places where they show up for their lunches, they'll have some light activities that, it's a time for the kids to hang out a little bit. They're getting fed and they're getting fed.
Yeah.
They're getting fed in more ways than one.
Fed with participation and camaraderie and some guidance. Wonderful choice, Shannon. Thank you for bringing that to everyone's attention.
Absolutely. I think they deserve a little pat on the back for all their hard work.
Absolutely. So if you are listening to this and you are part of the summer lunch program here in San Juan County, it doesn't matter where you're at, and you're helping with our kids here in this local community, we want to tell you we see you, we thank you, we want to give you props for all that you do for our community. Keep doing that, because a lot of those kids will move on to do great things. And they'll look back and remember the stuff that has been done for them. So we want to say thank you and recognize you here at the Lyons Pride. So welcome to the Pride Summer Lunch Program in San Juan County. Thank you, Shannon, for that. It's fantastic. So we're going to wrap it up today. Thank you for listening to today's episode. Go to sjcbroker.com. Schedule a private consultation with any one of us members here at the Lyons Group. We'd love to sit down with you, have a private consultation, talk about the market and how we can help you get an advantage in today's world in real estate. You can go to our Instagram page or Facebook page, like and follow us. Check out our YouTube channel. We've got all our podcasts on there offering great information for you, whether you're buying or selling. So thank you for listening. Until next time, we'll see you in the den.
Thank you for listening to The Den, powered by the Lyons Group. Hit the subscribe button to keep informed on real estate happenings. If you'd like to learn more about the Lyons Group, visit sjcbroker.com. Complex markets require complex strategies. The Lyons Group can give you a true advantage in any market. Whether you're buying or selling, residential or commercial, contact us directly at sjcbroker.com. We're time-tested experts with a client-first approach, and we'll see you next time in the den.